Within the interior of East Africa resides the small but beautiful nation of Uganda. However, Uganda is and has been for a long time been a poor country. This has largely been attributed to major political instability since it gained its independence in 1962. Despite this, the country has been long speculated to be poised for rapid economic and development growth on account of its significant natural resource deposits, abundant fertile agricultural land, and large working age population. But like all developing nations, Uganda has been in need of significant monetary investment to aid in the development of heavy industry, increase public utilities, and scale up infrastructure to meet the demands of a growing economy and population. This is why Uganda laid out an aggressive 20-year-long civil aviation master plan to dramatically upgrade the country's overburdened and only international airport, Entebbe. Located 40 miles southwest of the capital, the goal of the project was to make the airport a regional hub, something particularly important for a landlocked country. Then, in 2015, the nation started looking for potential loan suppliers in order to obtain the mountains of capital needed for such an ambitious project. They found their supplier in the Chinese National Export-Import Bank of Exim. The $207 million 20-year-long contract secured the funding to begin construction. At face value, this seems like a perfectly normal and mutually beneficial deal, but it underpins a much larger and insidious scheme by the Chinese Communist Party to become a superpower. With construction at Entebbe well underway, things were going smoothly. However, the situation soured when the Ugandan Civil Aviation Authority started to look at the fine details of the hastily agreed upon contract, discovering some 13 separate clauses that were deemed unfriendly or toxic, including measures that essentially mortgaged out the airport, with all channels for mediation to be conducted through Chinese courts, and gave China the ability to approve and veto budgets. All this means is that China is in the driver's seat of the current contract and in control of any modifications to that contract in the future. Under pressure from China to make a deal quickly, Ugandan leaders either failed to identify these toxic clauses or decided to take a risk. Nevertheless, things started to erode in 2020 with the global economic crash, which crippled Uganda's financial situation. In a desperate attempt to renegotiate the contract in early 2021, the Chinese bank rejected. By late 2021, it's been rumored that Uganda has found itself unable to make payments, which triggered a takeover of the airport by China in November. While the full situation and extent of the issue is currently unknown, since both nations are trying to keep things quiet, a total takeover of the airport would not, however, be a surprising thing to occur. In fact, China, over the last decade, has seized many valuable infrastructure assets of developing countries on the back of its Belt and Road Initiative. Hailed as the project of the century by Chinese President Xi Jinping, the project seeks to dramatically expand global infrastructure with itself as the economic center, cementing China as a global superpower. Covering 65% of the world's total population and 140 countries, China has enticed specifically developing countries with massive loans for desperately needed infrastructure projects, totaling $500 billion so far. To put that mind-boggling figure into some perspective, under the Marshall Plan, the US spent $135 billion adjusted for inflation to help rebuild Western Europe after World War II, over 4 times less than the Belt and Road Initiative to date. However, a good portion of these loans to low-income countries are unlikely to be paid off, as it appears China does not assess the nation's ability to pay back the loan. When these defaults eventually occur, the recipient country is then forced to release assets to China, either the project itself like Entebbe, or some sort of other agreement that China agrees upon. In fact, in 2019, Uganda's southern neighbor Kenya almost forfeited the port of Mombasa, the largest port in Africa and by far the most important piece of economic infrastructure in the country. However, in saving the port, Kenya is now overburdened by a mountain of Chinese debt, costing the nation over 40% of all tax revenue to make payments. One such country that did end up losing its port was Sri Lanka, who now has to lease out the port to China for the next 99 years. Not only is this a major blow to Sri Lanka's economy and sovereignty, but it also has sparked fears that China might use the port as a naval base a mere 200 miles from its geopolitical rival, India. A similar situation occurred in Djibouti, giving China a forward naval base along the most important economic shipping lane in the world. Laos, who has let external debts get out of hand, will now be forced to cede a majority stake in the national power grid, effectively putting a political stranglehold on the nation. With huge fixtures of these economies being in control by the Chinese government, the developing countries become heavily influenced, if not financially subservient, to Beijing. If China owns your only major shipping port, who do you think you'll have to trade with? This is called debt trap diplomacy, and the motivation to utilize it ultimately stems from China's current economic conundrum. See, China has experienced unbelievable growth and industrialization in the last 40 years. However, that growth is largely attributed to the vast availability of very cheap labor. As wealth and productivity have steadily increased, that labor is slowly becoming less affordable and less competitive on the global stage, and it's starting to affect China's growth. This is called the middle income trap, of which countries such as Brazil and South Africa have experienced, ultimately stagnating their economic growth. But China has seen this coming for some time, and they have aspirations to become a superpower. Their strategy, which is enabled through the Belt and Road Initiative, is to relocate wealth generation and cheap labor to low-income countries, specifically in Africa, while transferring the domestic market to more complex industrial manufacturing and services, essentially making Africa China's new China. With Africa poised to undergo dramatic economic growth in the 21st century, akin to Asia's in the 20th, and an explosion of population to 3.8 billion by 2100, Africa will then become the world's new source for cheap labor, and China wants to be the main beneficiary of this economic boom. By utilizing debt trap diplomacy now, China can gain access and possession of critical and increasingly valuable pieces of economic infrastructure in Asia and elsewhere. But the 2020 financial crash changed everything. China has pivoted rather abruptly, with a decreasing desire to unload massive amounts of capital abroad due to its own domestic fears of financial meltdown, including the possibility of its largest property holder Evergrande defaulting. This has caused China's foreign direct investment to slow down even more than it already was. This is having a ripple effect across the world, and Africa is hit especially hard. Countries that were expecting to and relying on securing additional funding have found themselves cut off. A project to connect a super fast rail link between the port of Mombasa and Uganda has run out of money. In Kenya, the tracks end abruptly in the countryside, some 468 kilometers short of their destination. Strapped for cash, the country is resorting to refurbishing 19th century colonial British tracks that have laid covered by foliage for over half a century. Similar difficulties are being experienced in Cameroon and Nigeria, as total funding for the continent has dropped from 11 billion to 3.3 billion, a drop of over 70% in just the last 3 years. As these countries find out the hard way that the free-flowing capital of the last decade is not a guarantee, and that China is utilizing these projects for political and economic gain, the future of the Belt and Road Initiative is now in question. In the meantime, however, some countries like Uganda are having to pay the price.